All right, guys, let's start. Okay. So now we are doing your chapter number 2, factors, in your book number 5, which is your risk and investment management. Okay. Again, an easy chapter, right? Not a very difficult chapter. Many things you have already studied in this chapter. So when you think about FRM part 2, right? Especially your book number 5, which is your risk and your investment management. And in this, your risk and investment management, we talk about your factor. So what is this section about? This section is about the entire module is about your risk factor that drive your asset returns. So in FRM language, what your systematic risks drive your risk premium. So that's what we are trying to understand. This is central to your asset pricing, your portfolio construction, your factor investing, your risk attribution, your stress testing. So the 3 modules here in your IM2, right? Your investment management 2. First, your value investing and your macroeconomic factors. Second, you're managing volatility and dynamic risk factor. Third is your value and momentum strategies. These connect directly to your market risk, your portfolio risk, your stress testing, your asset management risk, your risk premium decomposition. So we'll try to understand that. Okay. So again, interesting topics. We'll go one by one. So let's try to decipher it, guys. So fine. So in this part, when we go, right? So when you talk about module 1, which is your value investing and your macroeconomic factors. So we have topics such as your value investing, your macroeconomic factors, your economic growth, your inflation, your volatility, other economic factors. So the module is trying to answer your one specific question, that why do assets earn your risk premium? What risk factors drive your returns? And this connects heavily to your Fama-French factor models, which you studied in FRM part 1 also, macro stress testing, your scenario analysis, your risk budgeting, etc. Right? So again, pretty straightforward, pretty simple. Let's go ahead. All right, from here, the topic starts, right? So let's try to go now concept by concept, right? So the first concept is, what we are trying to understand here is that what drives your risk premium, okay? The risk premiums are driven by your economy-wide fundamental factors and your tradable style factors. We break this into your 2 buckets. One is your macroeconomic factors, your inflation, your volatility, your productivity, your economic growth, your demographics. These affect your all assets. This links to your stress testing, which are macro shocks, your scenario analysis, your systematic risk factors. Then we have your, tradable style factor, which are your value, your momentum, your size. These are portfolio tilts. This links to your Fama-French 3-factor model, your Carhart 4-factor model, your factor risk attribution from a risk management lens. These are your systematic exposures that generate your profit and loss volatility. Okay. Then we have something called your book value per share. Book value per share is basically asset managed liability divided by your shares outstanding. This represents your liquidation value per share. Why this is important? Because value investing companies compares your market prices, your accounting value. If market price is kind of less than your book value, there is a potential value stock. So if you think of this in terms of your financial risk management, this particular topic connects to your accounting risk, your financial statement analysis, your credit risk, the firm balance sheet strength, your distress investing risk, right? Then we have something called your book to market, right? Book to market ratios. Basically, book to market is book value divided by market value. Again, here we can have high book to market, which is a value stock, low book to market, which is a growth stock. Important understanding here is that if market price is very high related to your book, we are getting low book to market. That's a great growth stock, right? Why growth stock? Because there are high expectation, there are high valuation, low current tangible value. So value stocks are cheap, value stocks are possibly distressed, and value stocks are market pessimism, right? Then we look at your, historical value or value growth stocks, right? Value growth strategy. The value growth strategy means long value stocks, short growth stocks. This is your market neutral factor strategy. Why this is important? Because this isolates the value factor premium This connects directly to your factor risk decomposition, your long short portfolio construction, your hedge fund strategies, your alternative risk premia. And then we have your historical performance. Value stocks historically outperformed, but they suffered during your late 1990s tech bubble, 2007-9 crisis, 2011 downturn. This is very important from the FRM perspective because it shows the value premium is not your free money, right? It has drawdowns. And once we understand this, right? So the next point is value a risk factor, right? The next point which comes to our mind is that is value a risk factor. So that is what we need to understand. The key exam idea which we need to inherit is that do value stock outperform because there is a market efficiency or there is a compensation for systematic risk? FRM lean towards your value premium may compensate investors for your distress risk, your economic downturn exposure, your higher cyclicality. And if you look at your connection to other cross connection to other FRM topics, when you look at your value premium, it connects to your Fama-French model. When you look at cyclical underperformance, it connects to your stress testing. When you look at your systematic risk, it connects to your market risk capital. When you look at your drawdowns, it has war limitation. When you look at downside risk, it is expected shortfall. So that is what we need to understand. Okay. If you look at the practice question, what is important to understand is that a low book to market value ratio is indicative of what? Again, I told you in my notes, low book to market means the market value is high related to book value. So that is a growth stock, right? So very simple idea, that's a growth stock. For the exam, please remember FRM loves to reverse such kind of ratio. They will ask book to market, sometimes market to book. So please understand low book to market is growth, high book to market is value, right? So keep that in mind very, very clearly. And we have understood this in your notes also. So the company's book value per share is equal to total asset minus total liabilities, all divided by the share outstanding. It indicates on a per share basis that the company would be worth if it is liquidated its asset and paid off its liability. Value stocks have high book to market ratios, while growth stocks have low book to market ratios, right? Okay. Then we look at your macroeconomic factors. When you look at your macroeconomic factors, we shift from your style factors to macro risk. This is extremely important for your risk managers. What we need to understand is that macro factors affect all your investors, such as your example of your inflation rising, your growth slowing. This affects your equities, your bond, your credit spread, your real estate, your FX. This is kind of systematic risk, cannot diversify away. Then the next point is shocks. Shocks matters more than your levels. Critical FRM concept, market reacts to unexpected changes, not the level. Example, if inflation is 5, but expected is 5, no major shock. Inflation is 5, but the expected is 3, big negative reaction. This connects to your event risk, your scenario analysis, your volatility spike, your surprise component, the risk model. And then the next one is the three most important macro factors are economic growth, your inflation and volatility. These drive your asset pricing, and we need to break them each down. Economic growth means higher growth, higher corporate earnings, equity positive, credit spread kind of tighten. Low growth means recession risk, your default risk, credit risk increases, connects to your credit risk model, your probability of default modeling, macro stress testing. Then we look at your inflation, rising inflation hurts your bonds, increases your discount rate, compresses your valuation, also central bank tightening. Liquidity withdrawal connects to your interest rate risk, your duration risk, your interest rate, banking book, your asset liability management risk. Then we have the volatility, higher volatility, risk of behavior, deleveraging, war increases, margin call rises, connect to your market risk capital, your pro-cyclicality, your liquidity spiral, your wrong way risk. And why this matter for FRM part 2? Because this module is foundational for your factor-based war, your stress testing, your macro scenario analysis, your risk attribution, your portfolio construction, your capital allocation, your alternative risk premia. When you look at the real world risk management application, if a bank or asset manager risk team asks what macro factor exposure do we have? Are we overexposed or growth slowdown? Are we short volatility? Are we implicitly long value? This is your factor risk decomposition, right? When we look at the bigger picture, the summary, the This particular section teaches your risk premia, come from your systematic risk factors. Value investing is a compensated risk factor. Macro shocks drive your asset prices. Unexpected changes matter more than your levels. And growth, your inflation, and volatility are your core macro drivers, right? So that we need to understand clearly. Okay. Once we have got a hang of this, right, then we go to the next part, right? Then we go to the next part, which is your economic growth, right? So now we are entering the macro engine of asset pricing. This is where FRM part two becomes truly integrated across your market risk, credit risk, stress testing, and asset management. So if you look at your economic growth right now, so this particular slide explains how economic growth drives your asset returns. So the first concept here is, which we need to understand, is that risky versus safe assets across your growth cycle. So equities perform poorly during your low growth. Bond perform well. Why? Because when growth slows, corporate earning kind of fall, default risk rises, equity risk premium rises, investors shift to your safe asset. This is called your flight to safety. So stock goes down, government bond goes down. So from the FRM connection perspective, this links directly to your credit risk. Probability of default increases in recession, market risk, equity, war kind of spikes, stress testing, recession scenarios, liquidity risk, safe assets kind of preferred. Then we have the second point, which is the investor risk tolerance. Investor who bear your downturns should hold your equities. This is your consumption-based asset pricing logic. If you can tolerate your volatility, take your equity risk. Cannot tolerate your drawdown, prefer your bond. This links to your utility theory, your risk aversion parameter, your consumption CAPM, FRM exam, love it, understanding who holds risky assets and why, right? And again, the empirical evidence, very important for exam, is that during recessions, what has been seen is that government bonds gave you 12% plus, investment grade bond again gave you 12% plus, equities kind of underperform. During expansion, large stock gave you 12%, small stock gave you 16%. This teaches you that small caps are like your pro-cyclical. They outperform in strong growth, suffer in your downturns. And from the FRM perspective, this connects to your size factor, which is Fama-French. Small firms have higher cyclicality, higher business risk, higher beta, which we need to understand. Then we have your high yield bonds. Very interesting. Again, 7.4% in recession, high yield returns, 7.7% in expansion, almost similar. Why? Because high yield bonds have equity-like risk, right? And already pricing your default risk and carry your high coupon. This is exam relevant. Please remember that high yield bond behave like a hybrid between equity and bonds. Then look at your GDP. GDP and the consumption data. Quarterly GDP confirms high growth equities outperform, low growth bonds outperform. This is your pure macro factor exposure. And then we have your volatility during recession. Volatility increases during downturn. Large stock volatility 23.7% in recession, 14% in expansion. Government bonds 15.5% recession, 9.3% expansion. Important insight here is that even safe assets become volatile in your recession. This connects to your pro-cyclicality of your war, stress war, wrong way risk, right? Which we need to understand. The big risk management insight here is that economic growth is a systematic risk factor. It affects your equity prices, it affects your credit spread, it affects your default probabilities, recovery rate, your correlation. In stress testing, you always shock the GDP, right? Which we need to understand. Okay. So once we have understood this, we go to the next part, which is a practice question. So which asset has similar returns in high and low growth? So answer is your high yield bonds, right? So answer is D. Why D? Because they show near neutral growth sensitivity. Remember that the behavior of small cap stock, large cap stock, government bonds are all different, right? From this one, right? So remember that. So again, I've already explained, but during period of recession, government and investment grade bonds outperform their equities and high yield bonds. During expansion periods, equity outperform bond. High yield bond returns appear indifferent to changes in economic growth, yielding 7.4% recession, 7.7% expansion. High yield bonds are kind of, show near neutral growth sensitivity. Okay. Then the next topic is inflation, right? So now we move to your inflation. arguably one of the most important macro risk factors in FRM, right? The first concept here is that high inflation hurt all assets. High inflation increases your uncertainty, raises your discount rates, raises your risk premium, increases your volatility. All assets perform better in your low inflation, right? That you need to know, right? Then there is a impact on stocks, low inflation, right? When we have right low inflation, large stock 14.7%, small stock 17.6%, high inflation, large stock 8%, small stock 13%. Why do stocks suffer? Because the two reasons. One is the higher discount rate, one is the cost pressure on firms. Even though stocks are real assets, their valuation depend on your discount rates. Then if you try to cross link, right, this links to your dividend discount model, this links to your duration or the discount rate, sensitivity, duration of your equities, equity valuation risk, which we need to understand. Then we have the impact on bonds. Low inflation, government bond gives you 8.6%. High inflation returns lower by 3%. Why? Because bonds are fixed cash flow assets. Inflation reduce your real return. This is your classic inflation risk. In FRM, this connects to your interest rate risk, your duration, your convexity, your inflation-linked bonds, your asset liability management risk in banks. Then we have concept 4, which is why stocks also suffer in high inflation, right? Because it's kind of sound less intuitive, but stocks represent real firm. But when you have high inflation, there are high policy rate, higher volatility, lower PE ratios, lower valuation multiples. So even if earnings rise, valuation kind of compresses. And from the risk management application, what we need to understand is that inflation shock leads to parallel yield curve shifts, your equity market crash, your credit spread widening, currency volatility. That is why inflation is a key macro stress scenario, right? Which we need to remember, right? So remember that point. Okay. All right. Then we look at your volatility, right? When we look at your volatility, now we discuss volatility as a risk factor. This is very central to FRM. The first concept here is your VIX and equity return. VIX is your expected equity volatility, negative correlation with stock returns, meaning VIX goes up, your stock goes down. Why? Because volatility represents your uncertainty. From the FRM perspective, this connects to implied volatility, your value at risk spikes, your volatility clustering, your GARCH models, right? Then there is a concept called financial leverage or leverage effect. During your market drops, equity value goes down, debt stays constant, so leverage ratio kind of increases. Higher leverage means the equity risk is also increases. This increases your volatility further. This is called your leverage effect. From the FRM perspective, again, understand that this is a very important topic because in structural credit risk model, which you saw in your Merton model in your credit risk book, distance to default, again, in credit risk book, equity credit relationship, these are very, very beneficial, right? And the next concept is required rate increases or required return increases. Higher volatility means higher required return, means your higher discount rate, means your lower current stock price. This is your pure CAPM logic. Expected return is equal to risk-free rate plus your beta RM minus RF. Higher systematic risk means higher required return we want, right? And from the risk management perspective, what is important to understand is that volatility is a state variable, risk premium driver, stress multiplier. So in prices, volatility drives your margin calls, liquidity spirals, and contagion that we need to keep in mind. Okay. All right. Once we have understood this, then we go to your other macroeconomic factor. This kind of broadens the macro framework. We have different concept. The first concept here is productivity shock. Productivity affects your corporate profits, your growth, your equity returns. From 1980s to 90s, tech revolution, there was equity boom. Correlation was almost 50%. From the FRM perspective, productivity shocks are included in your dynamic, stochastic, general equilibrium model. Your what are those? We'll study ahead. Macro stress testing, your structural scenario design. The next part is your dynamic, stochastic, general equilibrium DGSC macro models. They model 7 shocks. One is your productivity, second is your investment, third is your preferences, fourth is your inflation, fifth is your monetary policy, sixth is your government spending, and seventh is your labor supply, right? These are your macro shock generators. In FRM, they are used in your regulatory stress tests, your central bank macro scenarios, your systematic risk analysis, which we need to know. Then we have your demographic risk, population age structure matters. Young, save and invest, old, disinvest, population ages, equity demand falls, risk aversion rises, equity premium kind of increases. From the FRM perspective, this connects to your long-term capital market assumptions, your pension fund risk, your longevity risk, your asset liability management modeling. Then the next one is about your political or the sovereign risk. Political instability leads to higher risk premium, not just emerging market. 2007-9 crisis showed developed markets are not immune. FRM connects this to your sovereign risk modeling, your country risk premium, your credit default swap spreads, your systemic risk contagion. Overall, the big integrated picture which you need to understand here is that the main macro risk factors are economic growth, your inflation, your volatility, your productivity, your demographics, your political risk. These drive your equity risk premium, your credit spread, your bond yield, your correlations, your volatility regimes, right? And why or what FRM wants you to understand is that they don't want you to memorize, right? They want you to understand which assets are pro-cyclical, which assets hedge your downturn, why volatility and inflation are kind of priced, how your macro shocks propagate to your asset prices, and how risk premia compensate your investor, right? So that is what we like to understand more, right? Okay, once we have done that, right, we go to the next part, which is your managing volatility and your dynamic risk factor, right? Which is the what you say model 2, right? So we are entering one of the most important or powerful areas in FRM part 2. We are looking at volatility, managing volatility and dynamic risk factors, volatility as a price risk factor and as a tradable asset. So we'll talk about managing volatility and dynamic risk factor. This module answers your three big questions. How do we manage a volatility risk? Is volatility kind of priced in the volatility premium? Can volatility and other macro risks be traded? How do your factor models evolve beyond your CAPM, right? This connects strongly to your market risk, war with expected shortfall, derivatives has options, your volatility swap, factor risk modeling, alternative risk premium strategy that we need to know, right? Okay. The other point here is that when you look at your managing your volatility risk, so let's try to break this carefully. Volatility can be mitigated by asset allocation. Invest in your less volatile asset like your bonds. Simple logic here is equity has high volatility, bond has lower volatility usually. So if you reduce your equity weight and increase your bonds, portfolio volatility kind of decreases. From the FRM perspective, this connects to your portfolio standard deviation formula, your correlation structure, your risk budgeting, your strategic asset allocation. So that is very important or important nuance. Bonds are not always your safe havens, right? Which we need to understand. Then we need to understand the correlation with your VIX. Stock correlation with VIX is almost like minus 0.39. Bond correlation with VIX is positive 0.12. Interpretation is that when VIX rises, stock falls strongly, bonds slightly rise or are less negatively impacted. So bonds hedge your volatility better than your stocks, but correlation is small, 0.12, not strongly protective. So in exam, you might be asked that is bond VIX correlation strongly negative? No, it is weakly positive, right? VEAKLY, weak, be positive, right? Then during the 2007-9 crisis, during the extreme crisis, both stocks and bonds fell. Why? Because your liquidity crisis was there, the forced deleveraging happened, credit spread widened, systematic risk increase. This is crucial to understand because safe havens fall under your systematic stress. And there is FRM cross linkage we have to understand. This connects to your contagion risk, your liquidity spirals, your wrong way risk, your systematic risk model that we need to understand, right? Then the next concept is VIX captures your volatility and uncertainty. There is an important nuance here. Volatility has statistical variability. Uncertainty is your unknown future risk. They are distinct but correlated, which captures your both. From the FRM perspective, this ties into your model risk, parameter uncertainty, risk premium decomposition that we need to understand, right? Then some strategies are volatility sensitive. Your currency carry trade, carry works when volatility is low, when volatility spike, funding currencies appreciate, carry trade unwinds, large losses occurs. And from the FRM connection, this connects to your tail risk, your skewness, your stress scenario, the risk factor sensitivities that we need to understand, right? The two ways to mitigate your volatility is that method one is to hold your less volatile asset like your bonds, defensive stocks, limitations in the fails in the systematic crisis. Method two is to buy volatile protection. Example, buy out of the money put option. Why out of the money? Because it is cheap in normal times, pay off large during your crash. This is your convex protection. From the FRM cross-link perspective, this connects to your delta hedging, your gamma exposure, your tail risk hedging, the Black-Scholes intuition we need to understand. So which mitigates your volatility risk, that we need to understand, right? So, okay. Now we go ahead and we look at your practice question, right? Which of the following investment options provides a means of mitigating your volatility risk? When I talk about mitigating volatility risk, again, simple point here is buying put option, right? Why buying put option? Because when you buy put option, put increase in value when the volatility rise, the market falls. That's a good point. Not the selling put option, not the buying equities, not the buying call option, right? So answer is A, right? Remember that, easy, not very difficult, just a general understanding. I think you all have got understanding of that in the option chapter in the FRM part one. There are two basic approaches to mitigate volatility risk. They are investing in less volatile assets like your bond and the stock, or buying volatility protection in the derivative market, such as buying out of the money put option, right? So this is very, very common, right? Either buy bonds or out of the money put option. Okay. Then we look at your volatility premiums. When I talk about volatility premiums, we move from your managing volatility to pricing your volatility. This is extremely important. We look at the concept. Volatility has a negative premium. Very important concept. Implied volatility VIX is greater than your realized volatility on average. Difference is 2 to 3%, meaning options are expensive on average. Why? Because investor demand your protection. So selling your volatility earns your premium. From the FRM perspective, this is called your volatility risk premium. Right. The concept we need to understand is the selling volatility profile. Basically, selling volatility generates a small steady gains, but large crash losses. Classic example is volatility swap index. Steady gains 1989 to 2007, lost 70% 2008. This is your negative skewness, right? Now, from the FRM perspective, this connects to your skewness, this connects to your tail risk, this connects to your short gamma exposure, your non-linear risk, which we need to understand, right? Then we look at your skewness data. Before 2008, skewness was minus 0.37, looks manageable. After including crisis, skewness is equal to minus 8.26, extreme left tail. SN is tail risk hides in your long samples. From the FRM application, this relates directly to your wall limitation, your expected shortfall superiority, stress testing necessity, etc. Okay, then theoretical relationship, expected RM, right? ERM is equal minus RF is equal to your gamma, sigma square M. Gamma is basically your risk aversion. Square M is basically your variance, meaning your higher volatility, higher expected market risk premium. This is your consumption-based asset pricing logic. So again, this connects to your intertemporal CAPM, risk aversion parameter, market Sharpe ratio. Empirically, lambda estimates vary widely. Exam may kind of test this relationship, is not strongly supported empirically, right? The lambda represent average market risk aversion, though empirically studies have estimated the coefficient as positive, negative, or zero, right? So remember that, right? Then the question comes, who should sell your volatility? Only investor who can withstand large losses. This is your institutional strategy. Example, pension fund, large hedge funds, not suitable for highly leveraged portfolios. Please remember that. Overall risk management insight here is that short volatility strategies increase systemic fragility, amplify your crashes, cause your pro-cyclicality. This links to your volatility targeting strategy, risk parity, and your margin spirals, which we need to keep in mind. Okay. Once we do that, we move to your dynamic risk factors. Dynamic risk factors means we move to your factor modeling. The first concept here is that CAPM is single factor. CAPM, only the market risk matters. High beta stock earn higher expected return. Compensate for bad state losses. From the FRM link perspective, this connects to your beta estimation, your systematic versus idiosyncratic risk, and your security market line. Then you look at your second concept, which is market portfolio is tradable. Market exposure can be obtained by your index funds, low-cost index funds, or ETFs, or futures. The market factor is easily tradable. Macro factors are not easily tradable. Your political risk, your growth risk, your inflation risk, these cannot be directly bought or sold. Exception is your volatility via your VIX futures or options. So tradable factors are easier to implement in portfolios. Non-tradable factors require your proxy portfolios or long short construction. And then we have a famous model called the Fama-French model, introduced in the 1993. Adds your size factor, your SMB, your value factor, HML. You studied this in your chapter number 6 of FRM part 1, arbitrage pricing theory and multi-factor model chapter. It goes beyond your CAPM. It's a tradable multi-factor model. FRM kind of cross links. This connects to your factor risk decomposition, your performance attribution, your alternative risk premium, and your smart beta strategy, right? Overall, if you zoom out, right? If you zoom out and take the big integrated view of module 2, this module teaches us that volatility is both a risk and a price factor. You can hedge your volatility. How? By buying your out-of-money puts. You can earn volatility premium by selling your option. Selling volatility has severe tail risk. CAPM is too simple. Multi-factor model needed. Some risk factors are tradable, some are not. So overall, how this connects to your FRM part 2 overall? This module links to your VAR. VAR is basically connected to your volatility clustering, then expected shortfall, tail losses from short volatility, then the credit risk, which is the equity volatility affects your probability of default, and stress testing, which is your volatility shock scenarios, then liquidity risk, which is basically the volatility spikes cause your funding stress, then derivatives, your option pricing, and implied volatility. So that we need to understand clearly. Okay. Once we have done that, we go to the next part, which is your famous Fama-French model, right? Fama-French model you understood in FRM part 1 also, right? So we are now entering into the core intellectual engine of modern asset pricing. One of the famous model is the Fama-French model, and the debate around its value, size, and momentum, right? We'll try to understand, right? Now, in the Fama-French model, what we need to understand is that this is one of the most important models in FRM part 2, especially in this chapter. So it answers why does CAPM fail to explain your cost sectional returns. So what we are trying to say is that CAPM is not enough. Your CAPM says that the expected return is equal to RF plus beta ERM minus RF, meaning all the market risk matters, but empirically small stocks have outperformed, value stocks have outperformed. CAPM cannot explain this, so Fama-French model kind of extended it. The next point here is the three factors of the Fama-French model. The model includes the market risk factor, same as your CAPM, market risk minus your risk-free rate. This captures your systematic market risk. Your SMB, small minus big, right, which is your basically return of small cap portfolio minus your return of large cap portfolio, capture the size effect. The interpretation is that if SMB, small minus big, is positive, small cap outperform. Stock is positive, SMB beta, it behaves like a small cap. Then we talk about your HML, which is high minus low. So return of high book to market value minus your low book to market growth captures the value effect. If a stock has positive HML beta, it behaves like a value stock. Then we have your Fama-French equation, which we have seen in your FRM part 1 also, right? Which is this one. So if you break it down, expected return is equal to risk-free rate plus beta I market into expected return of the market, beta I SMB into the expected return of SMB, beta HML in the expected return of HML, right? So that's what we are trying to do. It's a risk-free rate plus compensation for market exposure, compensation for size exposure, compensation for value exposure, right? So each beta represents your systematic risk exposure. Investor earn premium for bearing your market risk, your size risk, your value risk, which we need to understand comprehensively, right? Then we have a factor mimicking portfolio. SMB and HML are not your theoretical variable. They are your constructed portfolios. SMB has long small caps, short large caps. HML has long value stocks. The short growth stocks, these are tradable. That is very important. From the FRM perspective, this connects to your alternative risk premia, smart beta ETFs, your long short factor portfolios, your hedge fund strategies. That's what we need to understand very, very clearly. And also, what you need to keep in mind is that positive versus negative HML beta, right? So if beta HML is kind of greater than zero, it's a value tilt, higher expected return. If beta HML is kind of less than zero, it's a growth tilt, lower expected return. So value stocks on an upward adjustment related to your CAPM, and growth stocks on a downward adjustment, right? So that's what we kind of get, that we have to remember, right? So that is one thing which is very, very important. And from the FRM perspective, CAPM alpha may disappear once the Fama-French factors are included. This is key for your performance attribution. And your HML and SMB beta central zero, very, very important concept. Basically, idea here is that beta central zero means in CAPM average market beta is 1. In Fama-French, average SMB beta is 0. Average HML beta is 0. Why? Because these are long short portfolios. The average investor has no systematic size tilt, has no systematic value tilt unless you are intentionally chosen. The FRM understanding here is that this connect to your active versus passive investing, your factor tilting, your risk budgeting, that we need to understand very well, right? And then there's a constant beta assumption. Both CAPM and Fama-French assume betas are constant, but empirical evidence shows that betas rise in your crisis, change across regimes. This is called your time-varying beta. From the FRM perspective, this connects to your conditional CAPM, your GARCH models, your regime switching models, your stress testing frameworks. So are beta constant in reality? Or that's what we need to understand. And no, betas are not constant in reality, right? So that is what we need to understand in the Fama-French model. Once we have that understanding, then we go to the practice question. Which of the following is not a factor in the Fama-French three-factor model? So the capital asset pricing model, market risk factor, the small capitalization minus big capitalization, so SMB, the winner minus loser risk factor, the HML, the high book to market value minus low book to market value factor, right? So correct answer is the winner minus losers, right? This is not we have discussed anywhere, right? So winner minus loser, basically that is your momentum discovered by a different set of people like Jagadish and Dittman. So momentum is not in the original three-factor model. Later, Carhart added in the added it in the four-factor model, right? Which we need to understand. Not given here, but I'm just telling you. Remember that this is added in the four-factor model, right? So Fama-French model includes the following three risk factors: traditional capitalization model, a factor that captures size effect, and factor that captures the value growth, SMB, HML. You know this from FRM part 1. The winner minus losers momentum was discovered by Jagadish and Dittman and included in your Carhart four-factor model. Okay. Once we have seen this, we go to model number 3, right, which is the last module of this chapter, where we talk about value and your investment management strategy. So now we shift from your pricing to your strategy, right? So again, when you look at your value versus investment or value versus your momentum investment strategy, this is where your theory meets your empirical reality, I would say, right? We have 5 topics here: value versus momentum strategies, value investing, rational theories of the value premium, behavioral theories of the value premium, momentum investing. So quite a interesting topic, right? 5 topics. Okay, all right. Let's start with your first one, right? Value versus your momentum strategy, right? When you talk about value versus momentum strategy, so basically the concept here is that the size effect was discovered in early 1980s. Researcher was Banz and Reinkedam. 1981 found small stock outperform even after a beta adjustment. This led to your SMB factor, right? And then we look at what you say. Another concept here was size effect disappeared after publication. Size premium weakened significantly. This is important. There are 2 explanations here. Explanation 1 is data mining proposed by Fisher Black, right, in 1993. So the idea was the effect exists in a sample but disappear out of sample, meaning it may have been statistical luck, right? So FRM kind of connects it to model risk, your backtest overfitting, your data snooping bias, your multiple testing problems, very exam relevant. The explanation 2 was that investors learned about the small cap premium. They bought small cap, prices rose, premium kind of disappeared, markets arbitrage it away. Again, this connects to your market efficiency, your limits to arbitrage, your adaptive market hypothesis. Then another point here is that weak size effect remains. So small stock still sometimes earn slightly higher returns by the liquidity risk. Small stocks are less liquid, higher transaction cost, higher volatility. So part of a premium may compensate your liquidity risk. FRM cross linkage, what we understand is that this connect to your liquidity risk premium, Amihud illiquidity measure, market impact risk, which we need to understand. Okay. Now, once we have got hang of it, okay, before we go to the question, the few important points we need to understand is that value and momentum stronger in your small stocks. Empirical finding, value and momentum affects stronger in small stock. Why? Because small stock Less analyst coverage, more mispricing, higher behavioral bias. The FRM kind of connects it to behavioral finance, your information asymmetry, your limit to arbitrage, which we need to understand, right? So also there's a risk-adjusted excessive return, no longer large, even if raw returns look higher after adjusting for your market risk, your value, your momentum, your liquidity. Excess alpha kind of disappear. This is again uh, very important, right? So overall, the bigger picture here is that across whatever slides we have studied till now, we see an evolution from CAPM to the Fama-French to the momentum to the multi-factor model. We also see risk-based explanation, behavioral explanation, data mining debate, and EMH reaction, right? Now, this connect to your risk management. These factor models are used for your performance attribution, your risk decomposition, your stress testing, your capital allocation, your factor war, your portfolio construction. In a risk team, you decompose your portfolio return into your market plus size plus value plus momentum exposure. And the key takeaway here is the CAPM is kind of incomplete. Fama-French model adds the size and value, momentum is kind of separate. Betas are not constant in reality. Factor premiums may disappear after discovery. And liquidity and behavioral effect kind of matter, right? So that is what we need to understand here. Okay. So keep that in mind very clearly. Okay. Then we go to the practice question. When you look at practice question, right? Which of the following investment strategies stabilize your asset prices? Again, you're looking for stabilizing asset pricing. That is your value investment strategy. Answer is A. Why your value stabilizes your markets? Because it's a negative feedback, right? Value investing works like, price falls below fundamental value, value investor buy, buying pushes price back up. This is negative feedback mechanism. It reduces your mispricing. It dampens your volatility. This is kind of stabilizing. When you look at your momentum kind of destabilizes the market because there's a positive feedback. Momentum work like this. Price rise, investor buy because it is rising, price rise more. This is positive feedback. It will amplify your trend. This can create bubble. This is destabilizing. And from the FRM perspective, value is equal to mean reversion force. Momentum is equal to trend amplification force, right? So we need to understand that, right? So keep that in mind very clearly when we are looking at this part of the chapter, right? So this is what we have. Value and momentum are opposite to each other in the value investing, inherently stabilizing. It's a negative feedback strategy. With stocks that have fallen in value, eventually are priced low enough to become value investment, pushing your prices back up. Momentum is inherently destabilizing. It's a positive feedback strategy where stocks that have been increasing in value are attractive to investors. Investor buy them, so process remains even more. The prices increases even more, right? That we need to know, right? Okay, then we go to your value investing. When you look at your value investing, we go deeper, right? The value premium has kind of persisted, unlike your size. Value premium has persisted for decades, even though it suffered 1990s tech bubble, the 2007-9 crisis, various growth rallies. For long horizons, value delivered higher risk-adjusted return. Remember that. Another concept here is that historical foundation value originates from your Graham and Dodd's 1934 security analysis. The core idea is buy stocks trading below your intrinsic value. Book to market ratio is a proxy. High your book to market is your value. Low book to market is your growth. That we need to understand. Then another concept is the two explanation for value premium are there are two camps. One is your rational, one is a behavioral. This is your core FRM debate we need to understand, right? Okay. All right. With this, we move to your rational theoretical value premium, which we told, right? There are two camps, right? For the value premium, two explanation for value premium. One is your rational theories for value premium, which we are trying to understand now, right? So value stocks are riskier. Therefore, they must offer your higher expected returns. The concept one here is that value stocks perform poorly in bad times. Value stock co-move strongly in downturns, have higher beta in recessions, suffer when your macro risk hit. Thus, they have systematic risk. Investor require a compensation. So from the FRM perspective, this links to your consumption, CAPM, your intertemporal CAPM, your macro risk factors, premium compensate for your bad state risk, right? And then we look at your concept two, your macro risk behind your value premium. If you look at this particular slide, there's a labor income risk, there is investment growth, there is a long run consumption risk, there is a house and risk. When these deteriorate, value betas kind of increase, so value stocks get hit harder, hence your higher premium. Then we have your another concept which is structural explanation. Growth firms are flexible, intangible heavy, adaptable. Value firms are asset heavy or fixed capital, high adjustment costs. So in downturn, value firms suffer more. Hence, fundamentally, they are kind of riskier. And who should hold value? If you are able to tolerate your bad macro times, less sensitive to your labor income rates, your long horizon investor, you can earn value premium. This is your comparative advantage in the risk bearing. And from the FRM perspective, premium exists because not everyone can bear your value risk during a recession. That we need to understand, right? Then we have your behavioral theory of the value premium, which is given in the next slide, right? We need to understand that. Now, when we go to the behavioral theories of your value premium, there is an alternative explanation here. Value premium exists due to mispricing. The first concept is your over extrapolation. Investors see high growth, assume growth continues forever, bid up your growth stock too much. This creates your overpriced growth stocks. When growth disappoints, prices kind of fall, value stocks outperform. And look at your second concept, loss aversion and your mental accounting. Investor hate your losses more than your gains. Treat each stock separately. After your poor performance, value stocks look kind of scary. Investor demand high return to hold them. This creates your value premium. Then why the value premium persists? Because even if the mispricing is known, value underperforms for your long stretches, require your patience. Institution have short performance window. Many cannot stick with it, so premium kind of survives. And then we look at another concept with the value across asset classes. Value is not only equities. Example is yield curve carrying the bond, roll in commodities, FX carry, high interest rate currencies. All are your value style strategy. This is very, very powerful values across asset phenomenon. And then you look at your momentum investing, right, in the next part, right, which we try to understand. Okay, so in your momentum investing, when you talk about, we shift to your momentum. Concept one here is that discovered by Jagadish and Titman, 1993. Strategy was long pass winners, short pass losers, usually 6 to 12 months look back. The denoted as your WML, winner minus loser, or UMD, up minus down. The concept here was momentum is very profitable historically. Momentum has high return than size and value, low correlation with value, right, which is your negative 0.16. So it diversifies value and it crashes, but it crashes also badly, right? Then momentum is destabilizing. Momentum reinforces your trends in your prices. Sharp reversal causes your massive losses. Example, 2007-9 momentum crash, which we need to understand very clearly. 11 recorded crashes are there. 1930s, 2001, 2007-9, right? Why? Because when markets rebound sharply, loser stocks surge, short position gets squeezed, momentum gets destroyed, right? And then we go to your risky intervention risk. Momentum assumes trend continue, but when central banks intervene, government bailout, firms, trends reverse violently, momentum crashes. This connects to your tail risk, this connects to your liquidity risk, this connects to your short squeeze risk, this connects to your regime shift. Momentum has extreme negative skewness, which we need to understand. Then we look at the behavioral explanation of momentum. There are two possibilities. One is your underreaction, investor slow to incorporate your news, price drift upward gradually, momentum captures your drift. There is a, what do you say? The two possibilities when we take, right, two possibilities when we, so this is momentum which we talked about. Momentum risk includes tendency towards crashes, monetary policy, government intervention risk we discussed, right? And when we go into your behavioral theory, right, investor explain momentum through two camps, right? One is your overreaction and underperformance. So the two possibilities, one is your underreaction, right? Investors are slow to incorporate in news, prices drift upward gradually, momentum capture drift. Then is the overreaction, investor become kind of overconfident, push your prices too high, eventually they crash. Momentum profits your short term, loses your long term during reversal. And in your long run mean reversion, right, eventually prices revert to your fundamental. Momentum is short to medium term, value is long term. So value has a negative feedback. but stabilizing. There's a crash risk, moderate, theory risk-based versus behavior. Momentum is positive feedback, stabilizing. It's a destabilizing thing, and crash risk high. Theory is behavioral plus risk. And look at risk management perspective, very, very important for anybody who's operating in a global market. As a risk manager, momentum portfolios have high tail risk, high skewness, policy sensitivity, liquidity sensitive. Value portfolios are macro sensitive, recession exposure, more gradual drawdown. So factor exposure must be stress tested. Overall, what we need to take away from here is that value stabilizes your market, momentum destabilizes your market, value premium has rational and behavioral expectation, momentum premium has strong crash risk, factor premium compensate for bad times, momentum is often added as a fourth factor to Fama-French by the Carhart. So that is what we need to understand, and that completes our chapter, right? So not a very difficult chapter to understand, guys. You need to go back and revise it. Easy chapter, you have easy concept, right? You have to revise it obviously for one or twice times, but otherwise not a difficult chapter, right? Longish, I would say. The three modules: one is the value investing and macroeconomic factor, one is your managing volatility and dynamic risk factor, and third is your value and momentum investment strategy, right? Module one, value investing and macroeconomic factor, very easy, right? Value investing, what is there? Macroeconomic factors, economic growth, inflation, volatility. I think this is one of the easiest part. You can quickly read it and finish it, right? So just a general discussion. Then we go to managing volatility and dynamic risk factor. Here we talk about a little bit more volatility premiums, dynamic risk factor, Fama-French model, right? How do you manage your volatility risk, right? And then we look at premiums and what is the formula, right? Here and what has happened in the past, the dynamic risk factors, how it is incorporated, that we need to keep in mind, Fama-French model, and what are the factors, SMB, HML, etc. there, and Fama-French model has more things here, right? Which you need to keep in mind. Then you have value and momentum investment strategies. Your value and momentum strategies, value investing, rational theories of value premium, behavioral theories of the value premium, momentum investing, right? That we have and that we understand, right? Value and momentum strategies difference, right? Then you look at your value investing, then you look at your rational theories of value premium, behavioral theories of value premium, and then look at the momentum investing. What are the factors we need to consider in momentum investing and how it differs from the value investing, right? So very, very theoretical in nature, not at all difficult, but obviously you have to go back, read it twice or thrice and solve the question. But easy chapter, guys, easy chapter. Go back, revise it quickly and solve the question, okay? All right, guys, we'll stop here and I'll see you in the next lecture, okay? Thank you.